Hello and welcome to the Q&A for the latest issue of the Rule Investment Newsletter with me, Paul Harris, and with Rick Rule. Issue number 4 is about the 50 or so companies that will feature at the 2025 Rule Symposium next week from the 7th to the 11th of July. As a reminder, you can subscribe to the newsletter via Substack at realrickrule.substack.com. The idea of this issue was to provide a preview about the companies that will be participating in the event, with comment from Rick Rule on why he has invited them and why he has invested them, allowing you to do some preparation before the event in conjunction with the video interviews that Rick recorded with the companies, which are available in the Rule Classroom. There are companies from across the resource sector which we cover, which highlights the importance of building a diversified portfolio to manage risk, but also to benefit from the fact that different subsectors of the space will move at different times, which means have different investment time horizons and different times and opportunities. Some of these companies also featured in issue number 3 of our newsletter, which was on the investment theme of gold M&A, and some of them were also in issue number 2, which was on the investment theme of royalty and streaming companies. So please also refer to those. Now, the companies were arranged into categories reflecting the part of the sector they belong to: gold, silver, energy, critical minerals, royalty and streaming companies, and project generators. I'd like to give special thanks right now to Agnico Eagle Mines, First Majestic Silver, Aris Mining, and IAT Gold, who sponsored that issue of the newsletter and will also be the live stream sponsor next week at the event. And I will be hosting the live stream. So many thanks to those. Now, as these are Rick's personal choices, I feel for this Q&A, it's perhaps best to hand over to him to lead the conversation, and I will take on the supporting role. So let's bring in the man himself, Rick Rule. Rick, how are you?
I'm fine, Paul. The better for being on with you. I note that you, in your introduction, were a bit too modest. I would suggest that this has been a co-production. You are certainly responsible for the form and the content of the newsletter, despite the fact that I get to choose the theme and the company. So thank you for all of that. But with that said, let's begin the process of talking to our audience. As you note, every exhibitor at the conference, every public company exhibitor, must be owned in accounts owned and managed by the conference sponsors, myself included. And in fact, attendees might be pleased to know that we turn down more exhibitors than we accept. There can be no guarantee, because we own stock in an exhibitor, that the share price rises, but there is a guarantee that every single exhibitor at our conference has been vetted. It is also true, as you suggest, that there are different reasons to own different stocks. Not every stock is appropriate for every person. And finally, people need to know that any discussion that we might have about a stock, anything that we might write up about a stock, anything we might say is really a snapshot in time. Today's discussion is taking place on the 30th of June. And particularly for the small companies, there might be subsequent news releases that change our opinion, either positively or negatively. So people need to understand that this discussion is merely a snapshot in time, merely an indication. With that said, Paul, I'm particularly pleased with the group of exhibitors that we have at the conference, and as a consequence of that, the companies that were talked about in the newsletter that you produced this month. So as I say, let's perhaps begin with the process. It's probably time just to open the floodgates and answer questions.
Okay, I think it's worth reminding people we covered quite a range of different companies, from gold producers, from the biggest Agnico Eagle Mines to some that are more modest, like Luca Mining. We covered a lot of gold developers: Banyan Gold, Dakota Gold, IAT Gold, Gold Mining, Revival Gold. We've got a lot of silver names: First Majestic Silver, Abra Silver Resources, Argenta Silver, Dolly Varden Silver, Vizsla Silver, to name some. We've got base copper and base metals companies, energy and critical minerals companies, uranium companies, some of the companies from the range of the royalty and streaming space, from Wheaton Precious Metals, one of the biggest names out there, to some more modest names such as Elemental Altus Royalties. Recently got a very big new investor, and Ecora Resources, and of course the project generators, who are probably the smallest group of companies, or the group of smallest companies that we covered in the newsletter. So in some ways there's something for everybody, but as I mentioned in my earlier comments, it's a very broad portfolio of companies which gives excellent coverage of the natural resources space. Now we've got a number of questions starting to come in. And while these start compiling, I think I want to echo Rick's comment about the fact that the issue reflects a specific moment in time. Obviously, subsequent events, just general macroeconomic conditions, share prices go up, share prices go down, the investment case changes. A really good illustration of that is perhaps the first issue we did in the Rural Investment newsletter, which was about Canadian oil and gas. That was right at the start of the year, at the end of the first quarter, and that's been on quite an up and down swing in recent months due to movements in the oil price, but of course movements on the political scene with Canada's new premier, getting into things with US President Donald Trump, the trade spat there is ebbing and flowing, and with that the investment case for those stocks goes up and it goes down. But I think at the moment we're pretty much in an upswing there. So the thesis that Rick and I laid out in that newsletter, I think, is really showing some good progress.
Mark, pardon me, Paul, I might mention, I confuse you with the PM of Canada. They're calling you Mark.
Not counting.
Paul, I might mention that all of the companies mentioned in this month's newsletter and all of the companies that will be exhibiting at the conference have been interviewed. And those interviews are available. There were links to them in the newsletter, but they're available either at the Rural Investment Media website on YouTube, channel on YouTube, or they are available through the Rural Classroom. It's important to note, too, that the conference, the newsletter, and all of it are meant to be utilized through the classroom. The classroom has now 14,000 members, and it would be useful for all of you watching the interview, all of you attending the conference, all of you who read the newsletter, to participate in the discussion groups at the Rural Classroom. The idea is that we teach you in things like Introduction to Natural Resource Investing and in the instructional videos how to do the securities analysis that's necessary to make yourself a better investor. One way that you can easily multiply that effort is by sharing your information with others and taking advantage of the information compiled by others through the discussion groups at the Rural Classroom. To the extent that you want to start a discussion around a specific issuer, it is very easy to link the interview of the issuer into the discussion group at the Rural Classroom and then initiate a discussion. This is all about community. In fact, this is all about you.
Now we have one of our first questions in, Rick, and it's about Aris Mining. And this again highlights your point that investment cases continue to change. Aris Mining put out a news release this morning. It said it successfully installed and commissioned a second processing mill at its Segovia operations in Antioquia, Colombia, that will increase its processing capacity by 50% from 2,000 to 3,000 tons per day, and will help it increase production up towards an expected 210 to 250,000 ounces this year, up from about 190,000 ounces last year. And the question comes in, what does Rick think the future holds for Aris Mining and its Soto Norte project?
Well, certainly I'm a shareholder of Aris Mining. I'm a shareholder partly because I'm impressed by the geological endowment of Colombia. Paul, nobody knows it better than you. I'm impressed by the company's ability thus far to negotiate both the political and social landscape in Colombia, which hasn't been easy for outsiders to do. And I'm particularly attracted by the track record of the team in building their prior effort, Endeavour Mining, in West Africa. I am attracted to the range of Aris assets, including the troubled asset Marmato, Segovia, all of the assets. This is not for the faint of heart. the management team has come to live in Colombia, which I think is useful. They are close to their operations, which many people don't do. But I would describe this as still a speculative asset. Nobody has doubted the geological endowment of Colombia in general, or Segovia in particular. And I guess it was no surprise. They told us what they were going to do when they commenced production at Segovia, which is to say, increase their understanding of the ore body and use the free cash flow from the ore body to expand the infrastructure so that they could bring the net present value forward, which is what they're doing and precisely what they did in West Africa.
Now, let me chime in here, Rick. I had the pleasure and privilege to visit both of those assets last year. Aris took me to visit the Marmato Mine Develop, where they just started the tunnel for their Marmato Deeps new mining project, and also went to the Segovia operations and saw the first pieces put in place, if you like, of this plant expansion. I must say that the company seems to be operating very well. Both sites were very clean, seem to be well managed. They've got very good teams. They've also really unlocked the social dimension by putting in place an agreement structure with local small miners to be able to buy and process their ore, giving them fair value for it, helping them to advance technologically and also in safety aspects. So very solid relationships there with these key local stakeholders. And specifically in reference to the question about Soto Norte. Soto Norte is a development stage project in Santander province, which the company is earning into. A key aspect there, again, is going to be striking agreements with local miners, getting local communities on board, getting local politicians on board as a means to being able to get that all-important social license to operate, to build a mine there. I think they're going about it the right way, but obviously time will tell how and when and if that will be successful.
Paul, perhaps you could comment on the, how would you say, the evolution of community in Antioquia. When I first visited Antioquia 25 years ago, it was a very rough place. Narcotraficantes, rightists, communists. It was a very, very, very difficult place for a gringo to visit. How do you see the evolving sociology of Antioquia now?
I think you've still got those elements in place to varying degrees, depending on whereabouts you are in the province and in the country. But over the 17 years I've been living here in Colombia, I've certainly seen companies evolving their outreach methods, if you want to put it like that. The focus today really is on creating constructive links, creating real win-wins, helping local miners do better at their business, to enable the listed company, the formal company, to be able to do better at their business. Helping local people brings a lot of economic support to them, which in turn brings political support. And with that combination, companies have been able, not just Aris Mining, but other companies have been able to continue taking big steps forward. Another example of this is perhaps Aris's neighbor in Caldas, next door to Marmato, which is Collective Mining. They've got a very good exploration project there. They've been putting out great results. It's called Guayabales. They've been putting out great results on Apollo. And again, they've got very far-sighted and far-reaching social programs to help the local community feel part of development, to make them feel they'll be carried forward with any benefit that a future mining project there will bring. And that perhaps leads into another question. Given that Collective Mining is just at 5 short kilometers from Aris Mining's Marmato, Rick, what do you think the potential for an M&A transaction there is at some point in the future, whether that's Aris buying Collective or somebody bigger coming in and taking them both?
Well, it makes perfect sense. I was actually going to ask you that question. The Collective Mining people did a good job in the past developing a high quality asset in Colombia, in fact, selling it. So I think they would be sellers at the right price. And we note that the Aris team built Evolution through M&A. The idea, as you suggest, however, that the potential in Antioquia is great enough that they might in turn be consolidated by somebody larger after they've de-risked it, after they've proceeded with the community projects that you talk about, and after they've done the heavy lifting with regards to mine permitting and construction, I think is a possibility. What we've always tried to suggest in the rural classroom is that big mines and small mines all have big risks, and only big mines can make you big money. It's really worth your while talking about mineral accumulations in excess of 5 million ounces if you can do it. And the point that you make, which is to say that the Aris ground and the collective ground, if you think of it as a camp, uh, certainly meet that target. So my suspicion is that ultimately M&A is what will happen. It will be consolidated. Whether the first consolidation is collective into Aris is a different question. But my suspicion is that a district that's that robust, once it's been technically and socially de-risked, will likely be consolidated by a big player.
Now that Marmato district is looking like it could have a thumbsuck estimate of between 10 and 20 million ounces combining both, and obviously by both companies have continued to explore. So a lot of potential there. And of course, Collective Mining has a big strategic investor in the shape of Agnico Eagle Mines, and
Right.
they are also present at the symposium next week. So maybe that's a question for people to direct towards Agnico next week. Now, whilst on the subject of big districts, we have a question in about Banyan Gold, which, if I remember off the top of my head, has about 7 million ounces, give or take, in Yukon territory in Canada. The question is, Rick, what's your number one unanswered question related to Banyan Gold? What's the one thing that you want to see answered for you there?
There's actually three questions. The Yukon, I think, has suffered an awful lot from the failure of Victoria, and the question involves the political acceptability of mining with First Nations in the Yukon and with the government of the Yukon. I think that's going to have a favorable outcome, but you'll notice that I said think. The second question is the district scale potential suggests that it doesn't necessarily need to stop at 7 million ounces. They don't need to make it bigger, but they can make it bigger. So then the real question involves economics. The ounce size is formidable. Is the grade and is the metallurgy sufficient? In particular, will the return on investment exceed our 25% minimum? And what will return on capital employed and time value of money look like? I'm very impressed by Tara, the young CEO, and her lifetime, expertise in mining in the Yukon. It's unusual to see, never mind a young female CEO, but a young female CEO who grew up in mining and who grew up in mining in the region that he or she are operating in. So I'm attracted to this, but there are, as you suggest, Paul, some unanswered questions.
Well, I guess one of the obvious benefits, you mentioned Victoria Gold, which is just down the road from them. One of the benefits there is that Banyan Gold has access to great infrastructure. Because of that, Victoria Gold obviously put in the infrastructure to run a 200,000 ounce per year mine. So it has roads, it has power, it has water, has all these kind of things that presumably Banyan can benefit from its Ormac project as well.
And perhaps for a while at least, from furloughed employees at Victoria.
Okay, let's move on with the M&A theme. We've got a silver M&A question here. Could there be an economic case for Abra Silver to acquire Argenta Silver or vice versa? Abra's CEO, John Miniotis, is a finance M&A guy. Obviously, Argenta Silver is backed by Frank Juster, who's no stranger to putting deals together. What are your thoughts on how this could potentially play out, Rick? These guys are in Salta in Argentina.
Yeah, I don't think there's any immediate prospect of that. Frank is very pragmatic. He is always willing to buy or sell. I suspect that both companies are fairly early on in the value creation phase. And I suspect that both companies will want to better understand on behalf of their shareholders the value of the assets that they already control. So somebody who is betting on M&A in this circumstance probably has to wait a couple of years until each company has a better sense of the value of the deposits that they have. Certainly, I have a lot of attraction to both groups. Closer, of course, to Abra. I was a seed stage shareholder there. And as I say, I suggest that both of them are really reasonably early on in the value creation stage, and both of them are going to want to mature their projects before they consider a transaction.
Okay, now I mentioned our issue number 2 of the Rural Investment Newsletter was about royalty and streaming companies. And in that issue, we talked quite a bit about M&A and the need for consolidation there and some of the consolidation transactions that have happened. This morning, news was out that Origin Royalties shareholders agreed to be taken over by Triple Flag Royalties. Consolidation in the royalty space continues, and we have a number of questions, basically touching that theme. One of which is, given Franco-Nevada, it's the biggest company in the space, given that it needs more growth and EMX is so cheap, is there potential for EMX to be acquired by Franco? Or let's broaden that out. We've got a number of royalty and streaming companies participating in the symposium. Is there potential for Franco, and let's bring in Wheaton Precious Metals as well, for them to continue consolidating by buying some of these other companies?
I know that the Franco people know and like the EMX people. I know too that Pierre Lassonde, the founder of Franco, always liked the fact that EMX didn't have to buy royalties, but rather created them. So the idea that some transaction might take place there is not far-fetched. The truth is that there are huge valuation discrepancies between the largest royalty and streaming companies, which often trade at premiums, sometimes substantial premiums to the net asset value, and the smaller royalty companies, EMX and the others. And these value discrepancies usually are solved either by value arbitrageurs in the market, folks like me, buying the cheap ones, or they're solved by takeovers of the big ones by the small ones. Another interesting event took place, Paul, very recently. A different exhibitor, as far as Elemental Altus, saw the crypto giant Tether come in and become a 40% shareholder and indicate that they were looking at participating in the royalty and streaming space as a way to increase their ownership in gold. So what's interesting about that is that the potential field of companies looking to acquire other companies just gained a very, very formidable competitor. I think that you will likely see what I would describe as both horizontal and vertical mergers. I think among the smaller ones, you will likely see mergers of equals as companies merely seek to increase their size, lowering the general and administrative expense relative to assets under management, increasing their size too, so that they increase their trading liquidity, which generally results in higher share prices and hence lower cost of capital. I think also you will see bigger companies take over smaller companies. I think that you're going to see M&A as a very important theme in the royalty and streaming space.
Now, Rick, I want to sort of dig a little bit deeper on Elemental Altus. I've followed the company for a number of years. I've met Fred Bell, the CEO, many times. Very smart guy, very smart team. They've already done quite a bit of consolidation to help grow the company. They've also fought off a hostile transaction from another company that's participating in the symposium next week. With Tether coming in, Tether's a quadrillion dollars market capitalization. Potentially, that will mean that Elemental Altus will have the financial firepower to continue consolidating the sector. Is that your expectation there?
It is. I think that's the stated expectation of the Elemental Altus management team and also of Tether, which I think is a really unique new development in the sector. One of the things, Paul, that we talked about in the royalty and streaming issue of the newsletter is the fact that many investors look at royalty and streaming as a sunset or mature business. They suggest that the big transactions have already occurred and that the bigger companies have no visible means to growth. I think that's very untrue. Randy Smallwood, who will be presenting at this year's symposium, points out that the royalty and streaming companies enjoy greater market multiples to cash flow than base metals companies. And we all know that there's huge capital expenditures in front of the copper industry, building these gigantic copper gold porphyries, $8 billion capital bills or $10 billion capital bills. The idea that by isolating the byproduct gold and silver cash flows from the underlying copper cash flows at higher multiples means that a very important part of the capital stack going forward in the copper industry, by the way, $100 or $150 billion need, probably presents avenues to growth for the largest of the royalty and streaming companies that are greater than has ever existed in their past. The second theme that royalty and streaming investors, need to understand is that one of the paths by which host governments who would like to increase their participation in operating mineral deposits in their country, one of the ways that they can finance the acquisition of those minority interests is through a sale of a royalty or a stream. And I think these are going to be very, very, very important transactions going forward. So the idea that the growth is behind the industry is exactly wrong. The growth is in front of the industry. And I think that's going to impact royalty and streaming companies from the very smallest to the very largest.
Rick, can I be a little bit pedantic? One of the reasons that Tether has invested in Elemental Altus Royalties, as you explained, was to have exposure to more physical real assets, such as gold in this instance. Elemental Altus Royalties is a royal company. It doesn't actually produce any gold. It doesn't actually receive any gold. So is this perhaps an Tether misunderstanding things, or am I just overthinking things?
I think that Elemental Altus and other royalty companies in particular, but increasingly streaming companies too, can specify in the contract that rather than accepting dollar settlement, that they would prefer to receive settlement in specie, which is to say, really, truly receive gold and silver. Both Silver Wheaton and Franco-Nevada, in certain circumstances, receive, rather than cash settled payments, bullion. And that might be, depending on the wishes of the big shareholder, an increasing trend in the royalty and streaming space.
That would be quite an interesting development. Now, we're getting some really good questions in. Agnico Eagle Mines, the biggest gold producer out there by market capitalization, has taken a lot of strategic positions in smaller companies. Rick, what's your view on this? To what extent or not do you think that adds value to Agnico Eagle Mines? To what extent or not is that value represented in its market capitalization?
At last year's Natural Resources Investment Symposium, I was able to sit down in front of the audience with the then CEO, Sean Boyd, and talked specifically about that strategy. Sean pointed out to me that when Agnico Eagle comes into a new district or a new country and establishes an exploration office, that the front end expenditure before they do any exploration around the G&A is $1.5 million. So to the extent that they do a joint venture with a junior in a location or in a country that they aren't familiar with, to begin with, they save that upfront capital expenditure. It's also true, although he didn't say this, that to the extent that you have an unsuccessful effort, you still have something to sell. If you have an unsuccessful effort in exploration, you have a 100% write-off. If you have an unsuccessful effort in investing in a junior, you have a 50% write-off. Not a great outcome, but better than 100% write-off. But certainly the malaise that has infected the junior sector, the fact that the junior sector in many senses is selling at lower multiples to net asset value than we have ever seen, means that a cash-rich company who brings both cachet and expertise as well as money has an unusual array of opportunities. It's also true that the juniors in Canada, in the Abitibi in particular, have a fairly good inventory of deposits that, while they may not be economic as standalone deposits, could be very economic if they were paired with production infrastructure in the region, such as that which Agnico controls. This is truly a win-win, I think. I think the Agnico shareholders win, but I also think that the shareholders of the juniors tend to win because it gives those juniors access to Agnico's cachet. It gives them access to Agnico's technical support, and it gives them access, frankly, to adult supervision. The juniors are often too busy dreaming, while Agnico really is a construction company, an engineering company. So I think it's good in all regards. I'm particularly attracted to the fact that it's Agnico because the culture at Agnico, ever since I followed the company, going back to the Paul Penna days, has been uniquely supportive of their communities, supportive of their employees, supporting of their shareholders. Truly an amazing company. Only, by the way, 3 CEOs over 40 years.
Now, I was at the event last year, and I interviewed Sean Boyd after he spoke with you. And one of the things that really impressed me when he was on the Gold Legends panel, you asked the question of all the CEOs there, said, what other companies do you invest in? What other companies do you like? And everybody said, I invest in this, I invest in that, I invest in that. And Sean Boyd said, I've never invested in anybody else. I've never taken any other directorship because I believe 100% in Agnico Eagle Mines and what it's doing. I mean, that was quite remarkable, quite truly remarkable. Now, let's cross Canada and move to the Golden Triangle of British Columbia. A number of companies there. One of the world's biggest gold producer by production, Newmont, is there. There's also some very big development projects, and we'll have a couple of those at the symposium next week, one of which is Seabridge Mines. Seabridge has a massive gold copper deposit, and because of that, it's got a very high price tag to build it out. Because of that, Seabridge's market capitalization is very high, which perhaps makes a takeover unrealistic. Seabridge is therefore looking for a joint venture partner. How do you think Seabridge is going to play out, Rick?
I'm bullish about the gold price, Paul. I need to say that at the outset. I believe that U.S. government debt and deficit and the fact that the U.S. dollar is the reserve currency suggests that the purchasing power of the U.S. dollar over 10 years declines and declines markedly. I suspect that other fiat currencies will likely do worse. And the consequence of that is that I believe in higher gold prices. What makes Ker-Sulphiret's work is higher gold prices. This may well be the largest undeveloped copper gold deposit in the world, gold dominant. It's also a very large silver deposit. The question has always been, as you suggest, project economics. Can the free cash flow from the deposit amortize on a reasonable basis the incredible upfront capital cost? First of all, as time has gone on, in the 25 or so years that Seabridge has been in existence, they have spent some of that upfront capital cost. They're involved in $250 million of pre-production expenditures right now, while simultaneously de-risking the project. Right now, it's all about two things. It is about how fast does the gold price increase relative to the upfront capital costs, and it also is about in this monstrous sea of mineralization, where on the property was there sufficient rock preparation that they can have an upfront high-grade deposit, which will allow them capital payback. You'll recall that about 40% of the deposit was once controlled, first by Silver Standard and then by Pretium. And Bob Quartermain was confronted with the same problem. In this huge sea of mineralization, where is there sufficient rock preparation to generate the grades for a payback? He discovered that in the Brucejack fault, in a mine that is now controlled operated, in fact, by Newmont. And the big question for me is that almost certainly somewhere else on the Seabridge ground, there is an area where there was enough precipitation of mineralization, enough grade, that a high-grade starter operation can exist. The question is, when or whether they will find it.
Now, I had the pleasure and privilege to visit the project last year. CEO Rudy Frank invited me up. I think it was last August. I'm looking forward to catching up with him and getting an update on answering the question you just posed there, Rick, but also other things to do with the project's progress. We've got a slightly technical financial question in which I think is quite interesting, and reflecting on the comments you made about Banyan Gold, Rick. The question is return on invested capital, or ROIC, and return on capital employed, ROCE. They're both profitability ratios, but they do have a difference. So the question is, what's your preferred metric or ratio when you're considering a project? Which ones do you think is most relevant, most important?
Really, return on capital employed. I'm interested in total returns. Return on capital employed tells me how the capital stack can be formed, and who will do what to who within the capital stack. As you suggest, it's a technical question, but it's a very good question. I'm a lender, and return on invested capital often means that the issuer's interests and my interests are adverse. And I would prefer that we were all one happy family.
Okay. Now, at the top, I mentioned we cover about 50, or more than 50 companies across the resource space. Looking at the energy and critical minerals companies, we don't have a lithium company in there. Is there any reason why you don't have any lithium companies, Rick?
I don't own many lithium companies simply because the lithium space got so overheated that the valuations, from my point of view, weren't very attractive. I suspect that, I hope that everybody listening to this broadcast will attend our 2027 Natural Resource Investment Symposium. And I would suggest by then that all of the hype will have disappeared from the lithium business, and that it will be as unpopular as the uranium business was some years ago. I would note that there's a further risk with lithium, which is to say the incredible investments being made by Exxon, Chevron, Occidental, Mid-American utilities, people like that, in direct lithium extraction from saltwater brines. If this technology works, it's going to be a very rough day for both the evaporite and the hard rock lithium deposits to compete with them. My belief is that enough money got spent on lithium exploration at low enough prices that when yesterday's billion-dollar market capitalizations become tomorrow's $70 million market capitalizations, that we will find sufficient bargains in the lithium space that in the 2026 or 2027 Natural Resource Investment Symposium, that we'll likely have some lithium companies. But today, the relationship between price and value and the uncertainty of the lithium industry's response to emerging technologies like direct lithium extraction means that, as you suggest, we have nobody in that business on our roster.
Now, I want to sort of push back on you a little bit there. The lithium prices, collapsed from about, let's say, $80,000 to $85,000 per ton of LCE, lithium carbonate equivalent, to about $8,000 per ton at the moment. Consequently, share prices have fallen, 80 to 90%. So a lot of, there are some good companies out there. Their share prices have been decimated as well. So potentially we're getting into that period of time where it could be a good buying moment. But of course, I sort of take on board your comment about the big unknown, or one of the big unknowns is still whether DLE, direct lithium extraction, what impact will that have or not. Is that why you're holding off investing into the lithium space? The values are cheap, certainly, but there's this big unknown question that could make it, just completely irrelevant.
My reticence really has three forms. The first is that while the arithmetic is right, the sentiment isn't right yet. There's still hope in the lithium space. It isn't as roundly hated as uranium once was. The second is that the lithium boom was never a function of a shortage of lithium. It was a shortage of lithium processing capacity. And it's worthy to note that although demand projections for lithium are really robust, that many of the bottlenecks around processing capacities are past. It is easier to increase production at a brownfields facility than it is to build a greenfields facility. So my suspicion is that in the near term, rebounds in the lithium price will be enjoyed by Albemarle, SQM, by the incumbents. My hope is that out of the 200 pretenders who littered the lithium market 5 years ago, that 4 or 5 opportunities will come to the fore. People who made legitimate world scale discoveries, discoveries that will have over $10 billion in recoverable reserves and resources, companies that will generate a 25% return on capital employed, and companies that will be in the bottom quartile worldwide in the lithium production curve. Until I'm able to identify companies that conceivably combine those attributes, I'm not going to be a player.
Now, I think it's interesting, Rick, that you mentioned that there's still hope, or you still see hope in the lithium space. Just last week, the world's biggest producer, SQM, announced that it's laying off 5% of its workforce in Chile, where it has the Salar de Atacama operations. That's a lithium brine operation. It's the lowest cost operating asset in the world, with a production cost of about $4,500 per ton of LCE. So even at current low prices, it's still got a very healthy margin, and yet it's laid off 5% of its workforce, which is about some 400 people. That to me suggests that they're obviously tightening their belt, preparing for the worst, and that suggests perhaps that there isn't a lot of hope necessarily in the lithium space.
It could be simply that SQM is becoming more efficient. It could also be part of their ongoing negotiations with the Chilean government, particularly because of the pretty steady rise in popularity polls in Chile of the Chilean Communist Party, and expectations that SQM has that the political reality of Chile, at least with regards to mining, is changing for the worst. It's always good for mining companies to focus on cost and tighten their belt. It's always better for them to employ more capital per worker and retain the best and most productive part of their labor force rather than their entire labor force. So my hope is that that's what they're doing, but I must admit, I don't know for certain that that's what's taking place. Having more highly paid, highly productive workers and fewer poorly paid, less productive workers is always a good thing, unless you happen to be one of the lesser paid, lesser productive workers.
Now, let's poke the bear. Let's talk about Ivanhoe Electric and Robert Friedland's Ivanhoe Electric. The company's just released a pre-feasibility study last week, has an IRR of 24% at a copper price of $4.83 US per pound. It's looking at producing, I think, around 60,000 tons per year of copper cathode over 23 years. The capex there, I think, is 1.24 billion US dollars. So that gives a capital intensity of, let's say, $20,000 US dollars per ton. What's your view of that? The numbers seem to be very attractive. $20,000 per ton capital intensity is at the high end, but the industry is moving towards that as an average. So from that point of view, it's pretty much bang in the middle. What's your view there?
I wouldn't be hugely attracted to that, except for Robert Friedland. I've invested in Robert's companies since the mid 80s. He's a truly spectacular human being. There's a lot of good things about the deposit. It's on private land, which reduces the federal nexus for permitting. It's in central Arizona, surrounded by copper mines. The infrastructure includes highways, power, water, towns where copper miners live. All that's good. Not a huge deposit, but a decent sized deposit. a capital budget, an upfront capital budget that would cause many juniors to stumble, but really a rounding error for Robert and his financiers. You need to consider the Santa Cruz deposit, though, in the greater whole of Ivanhoe Electric. You need to understand that Robert is seeking to use that as his vehicle in the so-called battery metal space, primarily copper, and seeking to use technologies that he spent 30 years on, including the iPulse technology, to develop durable competitive advantage in the exploration business. So you can't look at Santa Cruz in isolation. Both the good news and the bad news is that it's part of a much bigger puzzle. This is a cluttered story. The market likes simple stories. This is a story where management's attention is at once focused on Santa Cruz, but also on Tintic and exploration ventures worldwide and technology. This will be expensive. I say all this like it's a curse. However, having those factors combined with Robert Friedland fires my greed. That's all I could say. It fires my.
The project is in Arizona in the United States. So let's broaden this question out. Ivanhoe Electric has already received an expression of interest from the US Export-Import Bank to underwrite a, I think, $850, $900 million loan for the development of Santa Cruz. President Trump is very keen on developing more copper supply, domestic copper supply in the US. There's a Section 232 trade investigation into copper underway. President Trump is looking at expediting permitting. What's your view in general of copper production potential in the United States over the next few years?
It's become a little brighter. There's a lot of stuff that Trump talked about that he didn't do. But the one thing that he does appear to be actively doing is changing the inertia in the permitting project. The fact that a different Arizona project, the Resolution project, now looks like it's proceeding to permitting after 27 long years tells me that the regulatory logjam is beginning to change, at least where there's local support. And I think that all inures to the benefit. It's interesting to me that Robert Friedland began talking to me about the United States being underexplored terrain 7 years ago. He said, here we go to all these places that we can't spell or pronounce, when we have wonderful exploration potential at home. As usual, he was a visionary. Whether he was lucky or smart with regards to coming into that during a period where the regulatory regime began to change is an interesting question. He was also smart enough, after he secured the deposit, to go and buy the land. It's important to note that this isn't on state or federal land. This is on private land. It's a brownfield site, which means that many of the permitting difficulties that Florence had or that Resolution had will not be problems for Robert. And I think that's important to understand. It's also worth noting that he had the good sense to have a very promotional picture of himself and President Trump and the Crown Prince of Saudi Arabia not too long ago, dispelling perhaps some doubts about his ability to get it permitted and getting it financed.
Now, my recollection and my timing may be wrong here, but I've been attending the World Copper Conference in Santiago, Chile, every April for the past 10 years or so. And going back a few years, Richard Atkinson, who was then President and CEO of Freeport-McMoRan, told the audience, why do we need to go anywhere else? We've got all we need in Arizona around our existing assets. Robert Friedland was presenting there as well. So maybe he heard that and that was the trigger there. But I could have my timing wrong there. Okay, now this is another sort of investor sort of technical question on gold. Gold price, very, very high. A lot of the companies have appreciated in value. The question is, there's obviously a lot more value and upside left in gold miners. But how do you, as an investor, Rick, psychologically wire yourself to continue buying into existing investments or opening new investments when their share prices have risen so much over the past year or so? How do you square that away mentally?
Paul, I'm a value investor. And so when I buy a company, I construct a very simplistic model. Never perfect, but usually better than other people's models because most other people don't do models. And I note that, as an example, over the last 18 months, the Agnico Eagle share price has doubled. But the net present value of Agnico Eagle's future cash flows at current gold prices is substantially higher than the value that Agnico Eagle demonstrated 18 months ago at lower prices. In other words, if you are in a $3,200 gold environment, you need to pay more for future cash flows than you would have paid in a $2,200 gold environment. I would argue that Agnico Eagle, as an example, is by most valuation methods cheaper today than it was 18 months ago when it was selling at half of today's prices. The other thing I would note is that this bull market is following the traditional and predictable path. Gold moved first, and it took a long time before the increase that we saw in the gold prices began to improve producers' margins, but also improve the share prices of the senior producers. What has traditionally happened, we've talked about this in the letter and also at the classroom, is that the best of the best, the Agnicos, the Francos, the Wheatons move first, and then the best of the rest move, and then the rest move, and then the mid-tiers move, and then the junior producers move, and then the developers move, and then the explorers move. It is relatively simple if you've been around for long enough to figure out who the best players in each category are and try and do valuation arbitrage between all of them. What's also important is that investors look at the sector through their own prism. How much work do they want to do? What's their time preference? How much risk do they want to take? An argument could be made, Paul, and you and I have both made it in different forums, that for most people, capturing the market's beta, which is, I would suggest, the outperformance of the gold mining sector relative to general market securities in a gold bull market, is sufficient that many investors should own Franco, Wheaton, and Agnico Eagle and leave it there. You don't need to earn alpha and work for alpha, accept the risks of alpha, if you can expect 200 or 300% returns from beta over 5 years. So for a certain segment of the population, you own the best of the best, and then you get on with your life. You play some golf, you read some books, you have some beers, play with your kids or your grandkids, call it a day. Not about outcome.
What was the fun in that?
Who are restless and greedy, people like me, and those of us who like to confuse ourselves with following 60 or 70 stocks, spending an hour a month on each stock, are in for a really, really, really good time. We are in a traditional gold bull market.
I think that's an important lesson.
A lot of legs.
I think that's an important lesson you're mentioning there, Rick. The sort of investor discipline aspect of it. A lot of people tend to get anchored to the price point they bought out a year ago, 6 months ago, 2 years ago. But in the words of Warren Buffett, every day you have to ask yourself, what's the best investment opportunity for me today? Forget the past. What's the best thing today? Okay, we're coming to the end of our time. Dundee Precious Metals is one of our companies. It's one of the companies we talked about in the gold M&A space. And lo and behold, they announced a transaction a couple of weeks ago to buy Adriatic Metals. Rick, let's talk a little bit about this transaction. Why does this transaction make sense?
Makes sense for a lot of reasons. Adriatic, I would say, has had some teething problems putting this mine in production. Volcanogenic massive sulfide deposit. The Dundee guys are pretty good at building volcanogenic massive sulfide deposits in southeastern Europe, which is precisely what this is. There are synergies between the people. They like each other. So the cultural difficulties that often accompany an M&A transaction probably don't occur. I would urge people listening to this discussion to review the copy of the newsletter about M&A, where we talked about the potential virtues in mergers and acquisition, including lower general and administrative expense relative to net asset value and free cash flow. Good thing. Increasing scope and scale, meaning that management teams could allocate their capital and their expertise across multiple deposits, which is to say, make investment decisions that were unconstrained by choice, but also the fact that larger market capitalization companies generally had more trading liquidity, as a consequence, higher share prices at a lower cost of capital. This is a very impressive set of virtues. It's particularly impressive because what Adriatic requires is building and operating expertise in volcanogenic massive sulfide deposits in Southeast Europe, which is precisely what Dundee offers. It's also useful because the market was beginning to ask, was Dundee buying back shares because they had no viable use for their free cash flow? In other words, where was Dundee's growth going to come from? Well, now we know. In volcanogenic massive sulfides, as Ali used to say, they throw punches in bunches, which is to say they very seldom occur in isolation. At Adriatic, they drilled off enough of the deposit that they had sufficient economics to build it. But the exploration upside around that deposit, I would argue, is quite high. And I think that the ability both by way of access to capital, but also by way of access to human resources, will speed the development of this district, with Dundee holding the reins.
I think another aspect to tack on the end there, Rick, Dundee was sitting on a very, very hefty cash position. And so entering this transaction perhaps relieves some potential vulnerability to incoming hostile M&A as well. I think we're down to our final question, and let's focus on silver again. And the question is, given that the hypothesis is that silver will have a ferocious catch-up rally in the latter part of a gold bull market, if one is still expecting a multi-year gold bull market to continue rolling forward, is it too early in the cycle to be investing in silver?
That depends on the investor, Paul. As you'll come to know about me, I'm pathologically cheap and I hate overpaying. So for me, if I'm not early, I miss the train. So I have been deploying among silver names with the expectation that I might be a year early, because I have a psychological flaw. I can't be 3 months late. I have to be a year early. For other investors, that will really depend on their orientation. I'll tell you this. There's no asset class with more volatile upside than high quality silver juniors. Doug Casey has pointed out the combined market capitalization of the decent silver juniors is so low that when the precious metals bull market attracts the attention of generalist investors and they begin to deploy in the space, they're just, well, as Doug Casey puts it, it's like trying to siphon Hoover Dam through a garden hose. I participated in this myself in the early part of the decade of the 1990s. We formed Silver Standard, which went from, if my memory serves me correctly, 72 cents to $45, and also Pan American, which went from 50 cents to $45. So the upside's dramatic. And what I've learned myself, Paul, at age 72, if you can believe that, is with potential rents like that, potential returns on capital employed, the time value of money becomes less significant. So I would prefer to be early. I would caution our listeners not to buy anything just because it purports to be looking for silver. Focus on the high quality names. Adriatic was certainly one. Abra's one. Aya is one. Don't get yourself in the silver pretenders, the highly promoted silver explorers that have had a couple of good hits but no continuity.
Now, I guess one thing to take away there, Rick, is the adage, you can't win if you don't play. So, you have to be positioned in silver stocks to be able to benefit from the rise as and when it comes. We've got 9 silver companies, developers and producers at the symposium next week. I think we're out of time, so let's end it for there. The symposium's on the 7th to the 11th of July. There's still time to register both for in-person attendance and for live stream attendance. I'll be hosting the live stream. Rick will be running around interviewing so many people, it's unreal. Please join us there. And of course, thank you very much for joining us today, and happy 4th of July.